That's what's so interesting about corporate credit over the last really years. It's not in the driver's seat. It's not the problem. I think it's other parts of the market that are really driving the bus. And corporate credit's really a passenger rather than a driver. And I think that's a function of, I think corporate Europe, corporate America has been more conservative post-COVID. They've seen that crisis. They've generally managed balance sheets with more conservatism. And I think the stories that have been going on around inflation, around the Fed, have been a little bit more macro in nature. So we think the corporate credit fundamentals are generally quite healthy. Corporate default rates remain manageable. And, I think corporate credit will remain more of a follower of markets for the moment rather than a leader.
It's amazing. I suppose it's testament to the ladies and gentlemen in that sector for pricing risk accurately, because there's no doubt about it. IG, okay, it has its popularity for obvious reasons, but the high yield end or somewhere in between, I would have expected to see way more defaults at these high rates, and yet I was completely wrong. We're actually seeing very low levels of default as well. So I guess you people in that sector are actually pricing risk appropriately.
Well, I think maybe even more credit should go to the corporate treasurers in these companies, because sure, there are certainly balance sheets that are over-levered and problem sectors, and I do think a really fascinating aspect of both the equity and the credit market is we're seeing a lot of idiosyncratic risk. We're seeing a lot of stocks move independently of each other, which is, I think, a healthy sign. But corporate CFOs, treasurers saw some of the lowest interest rates in human history, and it's almost remarkable they didn't lever up more in the face of that. And so as rates have normalized, interest coverage has normalized. It hasn't plummeted in a more extreme way. And I think that speaks to companies looked at those extraordinarily low interest rates but didn't over-extrapolate to a great degree.
The big deal we've been watching overnight between Capital One and Discover, for me, has question marks as to whether we're seeing problems cropping up in household credit. I mean, interest rates have been much tighter than households have been used to. And if anyone can navigate the corporate credit card story, it's going to be corporates, not households, that are going to manage this well. So just tell us what you're seeing from this space and whether there's a problem looming.
Yeah, so it's interesting, when I talk to my colleagues who work in asset-backed securities and cover a number of these consumer sectors, you're seeing some dispersion. You are seeing the lower end of the so-called subprime borrower be weaker, but the bulk of the American borrower who's not a subprime borrower is actually probably in better than average shape still. And if you look at overall U.S. Interest costs as a percentage of income, they're still quite low relative to history. So I think this is a story where the consumer is slowing a bit, but it's not going to cause the consumer to decelerate in a way that interrupts the soft landing. I think you also see that in some cases the markets are priced for this. I mean, our ABS analysts are actually quite constructive on new issue subprime auto ABS, which you would think by the words I just used, the nature of that product, that will be risky, that will be in trouble in this sort of environment. But we think it's priced for it. We think the structural protections in those deals in the current era are actually quite strong and strong enough to withstand that pressure.
This is the point.